We're about to talk about a number so big, it almost breaks your brain. But its consequences for the US economy? Oh, they are terrifyingly real. And this isn't some story about a problem down the road. This is about a financial trap that has already snapped shut. $882 billion. Let that sink in for a second. That is the staggering amount the United States government spent in fiscal year 2024 on just one thing: paying interest on its debt. To wrap your head around that, $882 billion is more than the entire U.S. defense budget. It's more than we spend on Medicare. In fact, it's bigger than what the government spends on veterans, education, and transportation, combined. The only thing that costs more is Social Security. It's just a staggering figure. Now, this isn't just another big expense on a spreadsheet. This is what economists call a debt doom loop, or an interest payment trap. And here's the most important thing you need to know. This is not some far-off, theoretical problem. America is already inside the trap. So, how does this trap actually work? What are the nuts and bolts of it? Let's break it down. The whole concept is really just simple, but absolutely brutal: math. Think of it like you're running on a treadmill. The trap springs when the interest rate on your debt, the speed of the treadmill, is higher than your economic growth rate, how fast you can run. You're forced to borrow more and more just to keep from flying off the back. You see, for about 40 years, the U.S. got what was basically a free lunch. Interest rates were always falling, and the economy was growing faster than the debt. Borrowing was cheap, no big deal. But that whole era slammed to a halt in 2022. To fight inflation, the Federal Reserve jacked up interest rates, and the entire equation just flipped upside down. Now, the average rate on our debt is over 3.2%, while our economy is only projected to grow at around 2%. The math has turned against us. And here's how that vicious cycle works. The government runs big deficits, so it has to issue more debt to cover them. But that bigger pile of debt, now with higher interest rates, leads to much higher interest payments. And what do those higher payments do? They make the deficit even worse, which means, you guessed it, the government has to issue even more debt. It's a spiral that just feeds on itself. Now, I know what you might be thinking. Hang on, haven't we been here before? I mean, interest rates were sky high back in the 1980s, right? And that's true, but comparing then to now misses three gigantic differences that make today's situation way, way more dangerous. Just look at the difference first, and this is the big one: the debt to GDP ratio. In the 80s, it was a totally manageable 35%. Today, it's a mind-boggling 125%. That means a simple 1% rate hike today has nearly 4 times the impact it did back then. Second, our demographics have flipped. Back then, we had the tailwind of baby boomers entering their peak earning years. Today, we've got the headwind of them retiring. And finally, the 40-year bull market in bonds that pushed rates down, that's over. The trend has completely reversed. And just look at this trajectory. It is terrifying. In just 4 years, from 2020 to 2024, the interest bill nearly tripled. By next year, it's on track to blow past $1 trillion. And by 2035, it's set to explode to over $1.8 trillion every single year. The speed here is just breathtaking. This all leads to a really dangerous effect called crowding out. Check this out. By 2035, projections show that more than 22 cents of every single tax dollar collected will go straight to bondholders, just to pay interest. That's money that can't be used for anything else. Not for soldiers, not for roads, not for science, not for Medicare. Okay, so this might all sound like some abstract government accounting problem, but it has very real, very direct consequences for your wallet and for your future. Let's dig into how. So, bottom line, what does a spiraling national interest bill actually mean for your life, for your family's financial future? Well, there are 4 huge consequences. First, the government has way less money and flexibility to respond to the next crisis, whether it's a recession or a pandemic. Second, the math eventually forces a terrible choice: either much higher taxes for you or painful cuts to benefits you might be counting on. Third, inflation starts to look like a tempting, easy way out for the government to devalue its own debt. And finally, the Federal Reserve gets totally trapped. Does it raise rates to fight inflation, making the government's debt problem worse? Or does it keep rates low to help the government, letting inflation run wild? It can't do both. And it's also worth asking, where is all this money actually going? Well, about a third of it, roughly $300 billion a year, flows right out of the U.S. economy to foreign countries and investors who own our debt. The rest, it goes to domestic holders, which are mostly big banks, financial institutions, and the wealthiest households. So in reality, it's a massive transfer of wealth from the average taxpayer to the owner of assets. So if we're well and truly in the trap, how do we get out? It really looks like there are only 3 possible ways this story can end. But first, let's be absolutely 100% clear. This is not a risk on the horizon. It's not a future problem. The interest payment trap is here. Right now, the doom loop is active and the math is already running against us. Okay, so this leaves us with 3 ways out. Path 1, you could call it the miracle option. Something like AI sparks a massive productivity boom and we just grow our way out of the problem. Possible, but you can't count on it. Path 2 is fiscal consolidation. That's the fancy term for deep, painful spending cuts and big tax hikes, a combo that's pretty much political suicide. And then there's Path 3, financial repression. This is the stealth option, where the government quietly lets inflation run hotter than interest rates, slowly, steadily eating away at the real value of its debt, and of course, your savings. And that, unfortunately, brings us to the most probable path. Not some big, dramatic default you'll see on the news. No, it's what the source material calls a soft default disguised as policy. A slow, quiet, steady erosion of the purchasing power of your money, paid for by savers and anyone on a fixed income. And that leaves us with one final, pretty heavy question to think about. What does it actually mean for a country not to default on some foreign bank, but to slowly, quietly, and deliberately default on its own citizen?